Hello, everybody. Welcome to Friday and another show of Talk Money with Tom. Really excited to have everybody here today. I want to thank you for joining us. Uh, if you have questions about retirement planning or tax management or money management, this is the place to go. You can send your question in. We already have several questions that came in this week. You can send them in at any time, including during the show. You send them to Ask Tom at talkmoneywithtom.com. Eason, who's also here on the show today, is one of our advisors. He will be taking the questions and being the moderator. He'll ask some follow-up questions. He'll input some other advice. Um, we believe that retirement is one of the most difficult goals to achieve in a sense of great retirement, but it's also one of the most enjoyable goals financially that you can possibly reach. And so this is an area that we really spend a lot of time on, that we try really hard to make sure that you can get something out of this show as far as that goes. So again, we are constantly putting new content about retirement and maximizing your retirement on our channel here. So you can subscribe to the channel if you'd like, or you can send us your email address and we will email you, the links to the content that we're placing on the channel. Or if you'd rather, you can schedule an appointment by clicking the website link there on the channel and just hit the book appointment button. And you can meet with Eason and I, or I actually, for 30 minutes, on a phone call or a video appointment. And we can, see if we can help you with anything that you might have as far as that goes. All right, so I'd like to start off every show really here just talking about a summary of what I saw happen this week in the market as a whole. So I put out a piece every single day about what I saw happen in the market. I've been doing that since the 22nd of March last year. And then we do these summaries on Fridays. And so about once every quarter, though, I do what I call Positive Friday. I think today's a great day to do that. The market's down. It's been down for a few weeks here. And really, one of the things that I try to do with these is just to point out all of the positive things that are happening in the market or the economy, and trying to offset the negative. So one of the challenges to being an investor in the stock market is really fighting the fear. Especially since most of the information that's out there is negative. Negative sells. It works. If I did negative Fridays instead of positive Fridays, I get a lot more people watching this video. But I do think it's very important to have some resource that points out all the good things that are happening to just offset. Now, this doesn't mean I'm ignoring the negative, doesn't mean I think the market's going to go skyrocketing. I'm a reactionary investor, which means I don't work on predictions. I don't predict where it's going to go and then try to, invest that way. I watch the price and I react to what happens to the price. And so that's basically it. But in order for me to feel confident about my exposure to the stock market, I need to know the positive pieces. So I'll start with just some history about big downturns and just kind of get you into the concept of what the odds are of having a big downturn. So if we go back to 1929, there have been 26 bear markets. So bear market is defined by a market that falls 20% or more. Okay, so 26 of them since 1929. That comes out to an average of every 3.6 years. All right, so let's think about that for a minute. We just had one last year. The average is every 3.6 years. Back to back is pretty rare. So again, look at the odds. The odds are that we're looking at a market here that could continue without a 20% downturn. The other thing we have to look at is just the amount of time that the market goes down versus up. So for example, in those bear markets, it was 9.6 months on average before it recovered and got back to where it was before it fell. If you look at the bull markets or the up markets that happened in between those bear markets, they lasted for 2.7 years. So think about that. The market goes up for a lot more days than it goes down. Again, probabilities would say that we are looking at a continuation of the upturn. Okay, again. And then if we look at data in a different way, if we look at it since World War II, things are actually better. There have been 14 bear markets, but they actually have been 5.4 years in between those. So more, I would call that the modern market. It's been 5.4 years in between, big downturns instead of 3.6, which we saw from 1929 to now. So again, look at the overall statistical concept of how we might end up in another big downturn, and it's not that common to happen. So that's one thing to always keep in mind. The next thing is to actually take a look at what's happening right now in the price movement of the market, right? So a few things are going on I think are very important. Number one is we have incredibly strong momentum, okay? So it's like a big giant battleship that's just steaming along. It's very difficult for that battleship to turn around tomorrow and start to go down, or this month, or even this year. Usually there's a lot more deterioration that happens before we start to see these bigger bear markets. And right now we don't really have any of that deterioration. The market's down a few percent, so far this month, but we're still, sitting at 50-day moving average is up, the 100-day moving average is up, the 200-day moving average is up. These are all things that just show the momentum is still very strong. And so right now you have to kind of lean towards that momentum and assume that we're still in an upward market until proven otherwise. The other part that happens when you have these types of great runs, it spends time at different areas. And when it spends time there, there's a lot of shares accumulated at those prices. And then that becomes support. So to give you an example, if somebody buys something at $10 a share and it goes up to $13 per share, they're really excited. They made great money. But let's say it drops back down to $10 a share for some reason. That person might say, hey, I bought it at 10, it went up. I'd like to buy it again. So if it gets there, I'm going to buy it again. That's support. We have a huge amount of support under the current prices, all the way down. So it makes it difficult for the market to really fall super hard, super fast, because people keep coming in and buying at these prices as far as that goes. And one of the great pieces is the individual investor, the rise of the individual investor, which has been phenomenal last year. Millions of new investors have come in. And one of the things seems to be buying the dip, and they keep coming in and buying the dip and buying the dip. And that is that support that's coming in as far as that goes. So we have that going on. Here's probably the most important thing, in that rates are low. Okay, and I've talked about this almost every single day because it is the most important component, and it's the big issue for looking at what might happen to the market, especially in some of these bigger bear markets, especially in more recent times. So what does that mean, though? So when rates are low, that means that the rates that you might get inside the bank are low. So on a regular basis, I have a client calling me saying, hey, look, I have a CD. It's coming due. They're only offering me 0.5% on the new CD. I want to pull it out of the bank and put it into my account with you. So I think you can probably make more than 0.5% in the stock and bond market. Well, think about that. It's happening all over the world, actually, as rates are low. And so money continues to pour in. So when rates are low, that's a big deal. The other thing that's really important about low rates has to do with housing, because actually the average person has more money in their house than they have in the stock market. And so when rates drop, people buy more homes. That increases the value of homes. It allows people to buy bigger homes. Homes are a huge piece of the economy. So many different industries are involved in the construction and sale of homes. And so the more that happens, the more you get this rotation of money. And then you have an average rate of mortgage right now, according to bank rate on a 30-year mortgage, is around 3%, which allows a lot of people to buy homes. And then some people refinance. And when they refinance, maybe they're at 5, now they're at 3. That's extra money. And they're permanently locking in these low rates, and theoretically will have this excess cash flow to spend on the economy or the stock market for the rest of the term of that loan. And so housing wealth effect is a huge component of what's going on in the economy and what have you. And again, that is caused by lower rates. We've also seen some higher retail sales. So the American consumer is unbelievable. Retail sales were supposed to drop last month. We got the Delta variant and all this, and it actually went up. Okay, so again, never discount the American consumer. We are unbelievable, or we lead the world really in consumption, and it really does help the economy here. Now, one of the big threats that has been coming along all year has been the threat of inflation. So ironically, we've had some problem areas like labor shortages, supply chain disruptions, and the Delta variant that have actually slowed the threat of inflation. And although those are all problems in and of themselves, it has taken off the table some of this big threat of high inflation. High inflation is tough on company earnings because at some point it becomes difficult to pass that inflation along to the consumer, and company earnings tend to drop in those scenarios. So that has been somewhat mitigated by what's happened here. There is some potential for government, money coming in again. They're working on this reconciliation package, which would be a stimulative environment for the stock market. They're working on this infrastructure package. Now, who knows what gets passed, when it gets passed, how it gets passed, but both of those are sitting there. If they did get passed, it would be a positive to the market. And so the virus itself has been a counteracting measure right now. And so we are seeing a topping. If you look at the charts, nationally, if you look at the charts, in a lot of the different states, you'll see that the rate of increase is slowing down, and we're starting to see a little bit of topping there. If you look at what happened in the UK, what happened in India during their big spikes, we did see a topping, and it came back down. So maybe, we'll see what happens. We'll see some topping in the Delta variant, which would be a positive for the market. Company earnings are unbelievable, really, really unbelievable. And, the reason the market is up so much since March of last year is because there was an expectation that company earnings would be doing quite well, and that has been true. There's lots of reasons they're up. Some of them are, from money that's coming from the government. Some of it is just because you can't discount the U.S. consumer. But nonetheless, they're up. And the expectation is that for the third quarter, earnings will be up another 28%. And so, again, phenomenal growth. Part of that growth is because of the virus causing companies to invest dramatically into technology, which is increase their productivity. And we are seeing, unbelievable productivity rates come out of companies. That probably won't go away. That could be a generational, movement for the stock market because of those productivity gains. Last thing, and let's just not discount the American stock market. Really, I mean, if you look worldwide, China is this big emerging country with all kinds of potential and what have you. Their stock market is falling apart right now because the regulators are walking in and doing things that are, probably seen as not capitalistic and what have you. So there's all kinds of problems happening there. It just makes our market look that much better. If you look around the world as a whole, the U.S. market is an amazing place, and money keeps flooding into this market from all around the world because this has a really good rate of return. The S&P 500 is super popular. We all live here. We can kind of see things that we don't like or what have you. But if you look at on a competitive basis around the globe, the U.S. stock market is incredible. And so I'd be really cautious to constantly be selling that just because there's a lot of negative articles out there. So again, all I'm trying to do here is give you something positive to think about as these things happen. So if the market continues down, which it very may likely here for a little while, keep remembering some of these positive things to go with all the negative stuff that you'll hear, because more negative articles come out now. I mean, it's amazing. It's a flood of them that I've seen. And all the people that are out there that have been calling for downturns, even though it hasn't been going down, are now, getting highlighted as far as that goes. So, I just try to provide a place where you can see something positive. So thank you for listening for this week's, summary and Positive Friday. And I look forward to, talking about what's going to happen next week. All right, Eason, let's get started on some of the questions. I know we have some that came in, and looking forward to, again, if you want to send any questions, it's not too late. Send them to Ask Tom at talkmoneywithtom.com, and Eason can fire away. And we'd love to answer your questions. This is really fun for us.
So in one of your videos, you mentioned quadruple witching Friday, which is today. Can you describe what that is and why is it important to know about it?
Yeah. Okay, so quadruple witching Friday is the 17th of September. In this particular case, that's today. And there are 4 different options contracts that expire today. I'm not an expert at options contracts. I deal with, kind of bread and butter investments, high net worth, situations where I don't really want to get into the options arena. But I do know this, and because I've been watching these types of things for, the last 35 years, it creates volatility. People are closing out contracts, buying stocks, selling stocks. Usually that volatility is on the negative side, as far as I have seen in the past. Now, here's the thing that I think is important to understand. If you don't know all of the mechanics of what's exactly happening in Quadruple Witching Friday, you have to be really careful that you don't try to analyze, the price movement of what's going on right now in this environment, because you've got this outside influence that actually is temporary. I would be much more interested to see what happens next week versus this week or the week before, because of this potential outside influence, which is this Quadruple Witching Friday. So I think that's what's important to understand. It causes volatility. It is happening. It is temporary. Be careful of, generating lots of thought process off of what's happening right now. Might be better to kind of wait and see what's going to happen next week or the week after that before we really can see, what's going to go on here for this time frame. So it's an interesting time frame. There's no doubt.
So you can't really use today to judge kind of like the macro or like the long-term trend. It's kind of just a event that happens every so often that affects the market just with people having to do something to fulfill options they have existing.
Yeah, that's right. I mean, I've made that mistake where, you think, oh, because it's just, you look at the normal market, you think, oh, it's following, that's going to create this and this and this. Um, but it's a temporary situation. So better to kind of hang in there and wait and see what happens after this temporary situation is over. Maybe it causes a catalyst that creates downturn for the next few weeks. Who knows? But really, it clouds the data. So be very careful right now with trying to draw conclusions from what's going on here.
So this is a pretty common question that we get a lot. I fell behind in my own savings to pay for my child's college. Now that they've finished college, I have some extra money to save. Where should I save this money? Is the order max Roth IRA, max 401k, and then put the excess into a taxable account?
Yeah, okay. So somebody is, paid for college. I got two kids in college right now. I can sympathize with that. And they feel like they've fallen behind on their retirement planning because of that. Where do I put the money? How do I deal with that? And there's lots of different options. It kind of depends on what you actually have available. But let's say that you work at a company that has a match. So you have to get that match. If they're going to, let's say you put in, they have all kinds of formulas, but I just use dollars. Let's say you're going to put in $1,000 and they're going to match that $1,000. That's 100% rate of return. You can't not get that. There isn't anything better than that. You're getting 100% rate of return on that, And again, every company has different matching criteria. Some don't match at all. But if you do have a match, put in enough to get the full match, because that is a great rate of return. And then the vehicles. So if you have a Roth 401k available, I would recommend that. And I've said this before, that the traditional 401k, you get the write-off. So when you put in that $1,000, you get to take that off of your income. That's fantastic. If you use the Roth, you don't get to take that after your income. So it's after tax dollars, which is more expensive, but then it grows tax-free for the rest of your life. And when you get to be 72, you don't have to take money out for required minimum distributions. The Roth is just so powerful. And I've just seen that throughout the practice. So I would start with the Roth 401k if I got the match. If I don't have a Roth 401k, then I'd look at the traditional 401k, especially if I got the match. So those got to be at the beginning of the story. Any vehicle. There's all kinds of different places that you might get a match, but those are the two biggest ones, certainly. And then you get into all these different areas like an IRA, which you do get a write-off on, or a Roth IRA, which you don't get a write-off on. Sometimes you don't qualify for a Roth IRA. It has income limits, so they have to take that into consideration. I would encourage you to take a look at non-retirement accounts, at least somewhat. Having 10 to 30% of your savings money going into just regular accounts, I call them trust accounts or individual accounts or taxable accounts, whatever you want to call them. They're not IRAs, they're not 401ks, they're not 403bs, 457 plans, all of those things. They're the object there is to create some liquidity and have something that's generating capital gains taxes in your future instead of ordinary income taxes that you might get out of an IRA or traditional 401k. And again, this is just something I've seen within the practice where people get kind of locked. They got all kinds of money in their house, but they don't want to sell it and they don't want to borrow against it. Fair enough. And then they have all kinds of money in these IRAs, which is great. They're wealthy, but then they want to do something big, buy another house or do something else, and they can't get to their money without getting killed in tax, especially single people who really have, these tax brackets are quite low for them. And so it's really nice to have some liquidity built up outside of your home and outside of your retirement plan. So that would be a piece of what I would look at as part of that catch up. But you got to get that match first, right? I think that is critical.
Yeah, and so if there's a match for your 401k, your Roth 401k, it's considered tax deferred. Whatever the employer puts in is considered tax deferred.
Yeah.
And so you should be aware of that. And so it's a nice way if you want to build kind of like three different buckets, tax deferred, tax free. It's a good way to get those two buckets done in a simpler way.
Yeah, that's a good point. What Ethan's saying is that, okay, if I put in $1,000 uh, into a Roth 401k and they match me 1,000, my 1,000 goes into this tax-free growth account. The other 1,000 for the match goes into a tax deferred, which just means it doesn't grow tax-free. It just I'll have to pay the taxes sometime down the road when I take it out or I'm forced to take it out, much like a traditional 401k would be. They don't allow that contribution from the company to go into that tax-free growth. But he's right. You actually kind of end up with all three things that way. If you have addition, catch the match on a Roth 401k, and then you've got your company add-on going into the tax deferred portion, and then you put some money into a taxable account. You can get all three, fairly simply that way. And yeah, that's a great strategy too. I like it.
Yeah. So another news event that's been kind of been pretty prominent this week is the Republicans are refusing to raise the debt ceilings. Should I be worried about the market and what kind of volatility should I expect?
Okay, so in my opinion, right now, this is the reason the market's falling. Probably most likely reason is the thought of not increasing the debt ceiling. Because if what happens is the government's running, a deficit, which just means that we have to borrow money to continue paying our bills and borrow money to continue paying the interest payments and principal payments essentially on these previously issued debt and treasuries. And so they have a ceiling, and the government runs up against that ceiling, and then it has to be moved up by Congress. That's one of the dumbest things I've ever heard of. I don't understand. This has been going on. We looked this up this morning since 1917. This is something I just would pray that they'd fix because it becomes sort of this political football. So right now, the Republicans are upset about this reconciliation bill that's running around 3.5 trillion. It might not be that big in the end. And one of the ways they're trying to stop the Democrats from getting that through is by telling them, look, we're not going to participate in increasing the debt ceiling, which obviously you'd have to do to issue this new, large spending program. And and on the other hand, you have the Democrats saying, well, look, they're not participating. They're going to let the country default. And so you have the Treasury Secretary, even today, talking about how bad it would be to default on Treasury. Oh, that's going to make the market nervous, really nervous. Now, the Democrats can, all by themselves, using the reconciliation process, pass a resolution to increase the debt ceiling. And so the chances of a default or a debt ceiling not being increased, in my opinion, are really, really low, to the point where this downturn that's being caused by this fear is probably a buying opportunity because once they do increase that debt ceiling, we probably get some of that pressure off. But the fear of it is causing people to take risk off the table. It is a really important component of what's happening right now, in my opinion. I really don't like this scenario at all. I think that there's got to be a better way to figure out how to raise the debt ceiling or get rid of it altogether. Putting something like this in the hands of politicians who then can play political football with it, well, the stock market ends up, getting hurt because of that, at least in the short term. That's hurting a lot of individual people, at least in the short term here. So, um, that's what's happening. It's a really good question. It's very topical. It is today's information. The market fell based on what Yellen said today. Again, it's back and forth. I don't want to assign blame to any one particular side, really. This is happening, has been happening for quite some time. It's just that the debt ceiling is a political football, and it shouldn't be, as far as that goes. This is a finance operation that should be done. They can decide what to spend or what not to spend, but they shouldn't be deciding any of the other aspects of it. That's a mistake.
So another kind of like topic that people have been kind of concerned about is Chairman Powell's term is ending in February. How does that kind of play into the market too?
Yeah, this is a question that came in. I think this is kind of interesting. So Chairman Powell is the chairman of the Federal Reserve. So the Federal Reserve, they do lots of different things, but the biggest thing that they do here that affects the stock market is set interest rates. And they have some stimulative programs that they've done in some of these downturns to try to, stimulate the economy. And in particular, buying $120 billion worth of bonds. They're it's a position that the party in power can put into place. They can change Chairman Powell in February to somebody else or reinstate him. So, he's got a Wall Street background. The market has done quite well during the period of time that he's there. This is the first Federal Reserve group that, in my opinion, has ever gone down the path they're going down now, which is, hey, we're gonna let, uh, sorry, we're gonna let interest rates run a little bit in an attempt to really get things going. Inflation run a little bit, in an attempt to get things going economically. And so I think that's a really key area, very important, because in the past, the Federal Reserve has just rapidly raised rates in an attempt to keep inflation under control and brought down the entire world economy twice, 2000 and 2008. And so this particular Federal Reserve has said something different, and they're working in a different way. They announced this last summer. First time I ever heard anything like this. So I do like that. I actually hope that they do reinstate them. Here's the key piece. In the end, it won't really matter to the market. We've had lots of changes within Fed governors. Some the markets like more than the other, and the basics of the market are still there as far as that goes. And so, theoretically, you could actually get somebody in there who's even more stimulative to the stock market and what have you too. So, really, it's not a big deal. The big deal is that the market, it doesn't like an uncertainty. It doesn't like uncertainty about the debt ceiling increase. It doesn't like uncertainty about who's going to be the Fed governor. And both of those are kind of coming up right now. And again, that's partly why we're seeing some of these, downturns that we're seeing right now too.
Cool. So this is a question that we kind of touch upon it every now and then is when should I start to think about having an estate plan? And if I have an existing estate plan, how often should I update it?
So when somebody says when should I have an estate plan, generally speaking, to me that means when should I have a living trust, for example. Everybody should have some kind of will, even if it's just something simple that you type up yourself. There's famous examples of people who wrote out a will on a napkin and things like that. So that's something that everybody should have, especially if you have any assets whatsoever. Um, it depends on the situation, but I believe here in California, once you get over $100,000 in assets, your estate will end up going through probate. And so once you get to that level, a living trust would avoid probate. So you have $1 million of net worth. Obviously, a living trust is going to help that pretty substantially to get through faster and easier for whoever your beneficiaries are, and specifically whoever your successor trustee is, or whoever's going to be settling your estate and helping with that would be a lot easier if that was a done in a living trust. So I'd say probably looking at more of an asset basis before you kind of take a look at that. But there are other issues. You get married, you have kids. I mean, these are situations where you'd like it to go smoother if something does happen to you. And so those are probably a couple of things where you kind of want to tie up the loose ends and have a decent estate plan in place. When you get into a really high net worth situation, an estate plan is obviously critical, but there's all kinds of other aspects for how the taxes are going to be paid, and is there life insurance attached to this? How you might handle the life insurance portion? Do you have a separate trust for the life insurance? I mean, there's a whole bunch of things, but in terms of like when you start, I would take a look at, what's the minimum amount that you'd have that, once you get to that level, you'll end up in probate in your state. And I would probably have a living trust at that point myself.
Yeah, and some of these accounts you can automatically avoid probate for your IRAs, or if you set up your bank account as a TOD, um, transfer on death account, these accounts automatically change title and they go to your beneficiaries without and skip the probate process. So you can keep out some of these assets, avoid probate. And so one reason that you want to avoid probate is it keeps it private. When it goes through probate, it goes through the courts and it becomes public. One big example would be Kobe. When Kobe passed, they had an issue with his estate because they forgot to add his most recent child, and that had to go through the court system. And then everything in Kobe's estate was kind of became public knowledge when he went through the court system.
Yeah, there's a lot of uh, examples of famous people because I mean they're famous, so people know them. They often have a lot of money, and they had just terrible estate plans or none at all, and all the different problems that happen. And unfortunately, it's not a fun subject. Who wants to deal with their own death? That's not something that a lot of people want to deal with. But, obviously, for some people, they're concerned about who that money's going to, and they want to make sure it's done as smoothly and as properly as possible. And having it, I mean, the idea behind probate and making it public was that if there were outstanding debts, they would literally post, on the courthouse, the assets, so the debtors could come by and see what was there and make a claim. And that's the idea behind that. But in today's world, that's just, information that you'd really rather not your beneficiaries having to deal with. So Kobe Bryant's, family is probably being, dragged through some pieces there that they wouldn't have to, but it does happen. I mean, nobody expects things to happen, but keeping up, maybe every 3 years at least, kind of keeping up with your estate plan, having it reviewed by your attorney, and then really significant events like when you have a child, that would be a time to take a look and to change your estate plan to include that child if you so desire. So yeah, it's a good point.
Yeah. So our next question is a little bit happier. You've seen like many different retirements. What are some habits, outside the world of personal finance and money that leads to like a happy retirement, so like a fulfilling retirement?
Yeah, that's kind of interesting question. Because mostly we deal with the finance, right? I mean, that's just what we're responsible for. We have a financial plan. We look at tax planning. We look at the asset management. We talk about those. But I meet with clients every 6 months on average, and so I've had I don't know 10,000 meetings. Get to know people, get to see like what's working and what's not working just in their lives. Like who's happy? I mean, that's a great question. Um, not exactly my area of expertise, but I do have a lot of exposure to that. And I look at that for myself and for any of my other clients. And I would say there's a couple things. Number one is most of my happy clients are pretty active. They've got some kind of structure, something that gets them out there doing something. Could be a hobby, flying model airplanes or knitting or quilting art, or my grandmother started painting. There's a lady at church who was an artist, and she started a little class, and so a bunch of ladies would get together. So it's very social, a lot of fun. She painted a couple hundred paintings. She got really good at it. When we had her memorial service in the gym in the church, we had all of her paintings up on the wall. It was really amazing, and she got great joy out of that. And she didn't start painting till she was 73. And so, following your bliss, so to speak, and finding something that you can kind of get up and do that might be volunteer work. These are things that I've seen that are quite, effective. Some people continue to work too. I mean, that's another one that I've seen people that are quite happy doing a part-time job, that they really like. So they like knitting and they're working at the yarn store. They love talking to people about it and such too. Some of these guys that I've run into at Home Depot, they're just pretty excited. This is like an area, this is something they do all the time. They're working in their yard on the sprinkler system or whatever, and they've got a knowledge base that they want to share, and they like interacting, and they're social. So keeping that social going in some form or fashion, I think is very effective. We have a lot of clients that have moved to retirement communities, where they have, literally like 100 different organizations that you can join in clubs. Some of those are somewhat restrained now because of the virus, but some of them are still happening in different ways. And so I think that's important, is that people that are into woodworking or whatever it is, that they really like. So I do think it's important. I would say the unhappy, if you go the other direction, are people that end up kind of sitting on the couch, and watch a lot of daytime TV or what have you, and don't really have something to kind of get them out the door, and get them, kind of involved in different areas. So, find your bliss. It's like a chance. Hey, you don't have to go to work. If assuming you did the financial part right, you don't have to go to work. So you can do almost anything. Take up bike riding, or it's just really cool. I've seen some great things that people have done.
Yeah, simple things you can do to stay active. Just, maybe that's like getting a dog or older dog that you can just go for a walk. There's
Hmm.
small things like that, just moving and being able to, that really helped my grandparents, was being able just to move about and, going around the neighborhood, just saying hi to people was really good for them.
Yeah, I have a client actually. That's a good point. I have a client who wrote a book called Mutual Rescue. So she was the CEO of basically the SPCA version here in the Valley, Humane Society, and to let people know that sometimes adopting an animal is an amazing thing. So it started off as a video series where they would go out and say, okay, hey, this person, they had all these health issues and all these things. Then they got a dog, and now they're taking the dog for a walk, and they got this dog to take care of, and their health has improved, and it became a book, and it's actually available on Amazon, called Mutual Rescue. It's really, really great book. I've read it, uh, and the object is that you're rescuing each other. You're rescuing this animal, and then that animal is rescuing you. And yeah, I mean, I've seen that. I've seen where a recent widow has now got a cat, or that type of thing, and it just, there's pros and cons to having animals. Believe me, I have three little dogs, but they're overall, the pros outweigh the cons. So that's another one. I have seen a lot of people that are quite happy with their animals, and so that's a good area too. Good point.
So this question just came in. So have you ever advised your clients to get a party for the executing of the estate and trust kind of?
Yeah. So I guess what they're asking there, and I have been asked this a couple times. Um, yeah, it's very difficult. You've also oftentimes picked somebody to be your successor, trustee, or take care of settling your estate. That's a really hard job. And so maybe it's a kid, one of your kids, their most responsible kid, all three of your kids, two of the three, whatever. I've seen all kinds of things. It can create some conflicts amongst those children as to what's going on. There's, settling that estate and money, And so one of the ways around that potentially is you hire a firm, you put them right into your trust, for example, that will settle your estate for you. A matter of fact, they have, those same firms can come in and pay your bills for you if you're unable to. They can coordinate your care at home if you're unable to. They usually charge by the hour. And so, yeah, like in my example, my money's all going into a big trust. I want my kids to get an income for life. Somebody has to manage that trust and make sure that they're hiring the right people. So these are all kind of third party administrators, so to speak, that you can hire in different areas depending on what you're looking for as far as that goes. And so, I mean, even settling your animals, you can get an establishment so that a portion of your money goes to a humane society with the idea, like I have 3 dogs, I like to keep them together if something happened to Allison and I, and the kids didn't want them for some reason. So all of these things are kind of third parties that are out there that can coordinate these scenarios that you have in your mind instead of just having a relative, a friend, or your children do it, which is the most common scenario, but it can be harder than you think. And so sometimes it's worth, having an organization come in, charge you by the hour, and get that done as far as that goes. So, yeah, I think it's actually a very fascinating area. It's something to look at. As far as that goes, I'm a big proponent of it. I've just seen people really struggle with trying to settle estates. I mean, you're not doing your kids any favors in that regard. It's nice that they're getting the money. It's probably more money than you got, but it's still a lot of effort.
And the nice thing about using a third party is you gotta vet them. You gotta, go through them. And they have expertise in this. They've done it for other people. And also you can give them kind of the lay of the land. You can tell them where's your accounts, where's your money. And sometimes those are a little bit more of an awkward conversation when you talk with your kids or friends and family that you want to have as your trustee or your executor.
That's a great point, Ethan. That because that happens. I have some parents that want to share everything with their kids. That's fine. I have other parents that really don't yet. But you could share all of that with this third party person who's going to be handling your state. You get to vet them. You get to figure them out. And hey, let's face it. If they're good, they're way better than your kids at it. Your kids have only done it 0 times, probably. It might be the only time they ever did it. They do it all the time, so they're going to know what happens, how to do it, how to get it through. Yeah, and if you're worried about privacy with your kids and don't really want them to find out until you do settle the estate, that's a way to do it. Because otherwise, they're basically now the kids are running around trying to figure out what do we have. I've had that happen so many times. Kids have no idea what the parents had. I mean, at all. They don't know about the assets. They don't know where it is. And then we're still finding things 3 years later, just because for whatever reason the mail got misdirected or something along those lines. And playing detective can be a real challenge for these kids. And so if you have this setup outside, they could have the list. They'd know what was happening, much more so you can keep them informed without having to disclose everything to your kids if that's a concern. Again, everybody's different on that. I don't have any problems with either way in terms of disclosure, but yeah, that's a really good point as far as that goes. So that's good stuff. So I want to thank everybody for coming today. I really appreciate the questions. Some really good questions today, actually. And hopefully the positive summary of what I see out there in the market will help you deal with what's happening right now in terms of these downturns and what have you too. And love hearing your questions. Keep sending them in. If you want to subscribe with the subscribe button, send us your email otherwise, or if you'd like to do an appointment, and have us talk to you about kind of your retirement plan, again, that's available also. You just hit the book appointment button on our website. Our website has a tremendous amount of content on it also. We really believe that education is a key component of creating, the best retirement that you can. So I want to thank everybody for coming so much today, and I really appreciate it. You guys have a good weekend. Thank you. See you next Friday.